So today we are going to talk about the Indian banking system. You know why our banking system is very strong and you will rarely see any shutdown of any banks in India. The Indian banking system is the backbone of the country's financial infrastructure. It facilitates savings, current and financial transactions for individuals, businesses and the government. It plays a central role in the economic development by mobilizing funds and channeling them into the productive activities. So who governs the banking in India? Have you any idea who governs the Indian banking system? It is RBI. It is Reserve Bank of India and it is also called as the central bank. It regulates and supervises the entire banking ecosystem. It also controls monetary policies, issues currencies and maintains financial stability in the country. There are two types of banks which is governed and regulated by the RBI. It is scheduled and non-scheduled commercial banks. In scheduled commercial banks, we have public sector banks like SBI, PNB, Bank of Baroda. Private banks, we have HDFC, ICICI, Axis, Kotak, and so on and so forth, right? So we have foreign banks like Citibank, HSBC. We have regional rural banks, which you would have seen generally in the tier 2 and tier 3 cities. We have cooperative banks, payment banks, small finance bank. All these banks are under commercial banks. There are NBFCs also who get the license from RBI to perform non-banking functions like lending or payments, but actually they cannot open current account or saving account and they cannot do regular banking transactions. That is why they have a certain license particular to an NBFC. So how these banks help in the economic development like mobilizing savings and promotes investments? It provides financial support to key sectors like agriculture, MSME, enables digital payments, enables digital financial inclusions through tech-driven services. Like if you would have heard this UPI, Jan Dhan, supports government initiatives like DBT, direct bank transfer, Mudra loans, right? So now the most important factor is that why Indian banks are very strong on this earth, and you will hardly see any banking getting shut down in India because it is a strong foundation and a strong governing body as RBI. You see, RBI directs the bank to report CRR. Now, what is CRR? CRR is a very fancy word. CRR is a cash reserve ratio which every bank has to report to RBI on a daily basis. And RBI can monitor this every fortnightly, means on every 15 days they can monitor this. This is just to keep a watch on how a particular bank is functioning. Is it getting stronger day by day or losing business day by day? So banks are required to keep a portion of their deposits with RBI as CRR. We have two technical words called CRR and SLR. And CRR is basically a cash reserve ratio. SLR is basically a saturated liquidity ratio. So CRR is the minimum percentage of a bank's total net demand and time liabilities. Or in a layman terms, you should understand that CRR is the certain portion of the business of the bank which is reported in the RBI portal, that it must keep in the form of cash reserves with the Reserve Bank of India. So the deposit is reserved in cash form only and no interest is paid by the RBI on this particular amount. So whatever CRR is maintained by the banks in the RBI, there is no interest which is paid by the RBI to the particular bank. It is just for the safety of the customers and prevents the banks from liquidation. So CRR, I told you what is CRR. So you should also understand what is the purpose of CRR. So the purpose of CRR is to ensure liquidity, safety and stability in the banking system, to control money supply in the economy. It also prevents excessive lending by the banks. It maintains public confidence in the financial system. So if the CRR keeps declining on a daily basis, then RBI will come forward and do inspections as what is going wrong with the banks, and if it finds some major issues, then it tries to merge with the bigger banks so that trust and Indian people money is never wiped out from the economy or from the banking system. But what happens if it does not get merged with the bigger banks? Then the customer will have an insurance of up to 5 lakhs only put together. Which means if you have 3 lakhs in the savings account or a current account and 2 lakhs in an FD, so you will get only 5 lakhs as an insured amount. And if you have 4 lakhs in the savings account and 5 lakhs in the FD, so put together it is 9 lakhs, but still you will get only 5 lakhs, which is covered under the DICGC, which is again a unit of RBI. However, it is hardly seen because in this case the RBI has to cancel the license and initiate closure of the banks. But again I am saying that is very rare in India, and most of the cases it gets merged with the larger banks. Therefore, you can see in India banks are rarely shut down and our funds are very safe with the banks, and you should be proud of the Indian banking system. You would have seen the real example of merger and restructuring in the case of Yes Banks, which was rescued by the SBI and others, and there was no loss to the depositors. In 2022, PMC Bank was merged with the Unity Small Finance Bank, if you remember. If in any case this situation happens, then RBI directs that particular banks to limit the withdrawal from 1,000 rupees to 25,000 rupees under the section of 35A of the Banking Regulation Act during distress. So you have to understand that if any banks goes, the liquidity, if any bank goes in the form of dilution, then the RBI directs that particular banks to limit the withdrawal, and the withdrawal limit has to be 1,000 to 25,000 rupees, which is under the section 35A of the Banking Regulation Act. This you would have seen during the COVID also. Hope you would have understood how strong our banking system is. Now, you should also know that the major merger of public sector banks in India was announced by our Honorable Finance Minister Nirmala Sitharaman on August 30, 2019 as part of the government's agenda to create stronger and more competitive banks. So what was the main reason for these public sector banks to merge? It was about strengthening the balance sheet, improving lending capacity, reducing NPAs by consolidating resources and create globally competitive banks. So now I'll also share you the banks which got merged in the public sector banks, like SBI Associate got merged with State Bank of India, Vijaya Bank and Dena Bank got merged with Bank of Baroda, Oriental Bank of Commerce and United Bank of India got merged with Punjab National Bank, Syndicate banks got merged with Canara Bank, Andhra Bank and Corporation Bank got merged with Union Bank of India, and Allahabad Bank got merged with Indian banks. So these were the banks who got merged with the larger banks. However, there are still 6 banks which are working independently as of now, like Indian Overseas Bank, UCO Bank, Bank of Maharashtra, Punjab and Sindh Bank, Bank of India and Central Bank of India. So they are operating individually. I don't know why it is still independent, and this can be better explained by the government. So this was all about the Indian banking system, and we should be proud to be banking in India, unlike any other bank outside India where you see no static regulations and you will keep seeing the fall of the banking system outside India.